Hello and welcome to Weekend Investing Daily Bytes. Today is 9th of May and we are shooting episode 223. A very tough market is upon us. We are basically following the mother market, the US market in all respects. The day US markets falls, we fall the next day. The day US markets rise, we rise the next day. So it seems that we have really no directional perspective of our own, and we are essentially following the global trends like most other markets are also. It is not just Indian markets that are behaving this way. The silver lining, if we want to see that, is that we are still within 10 to 15% of the top, whereas the US markets and many other markets have fallen much more. The damage this week, or let me say in the last couple of days, has been severe. Today also, while the larger index did not reflect the damage, the internals of the market got damaged pretty badly. The advanced decline ratio was also poor. There was one time during the day where the morning gap was almost covered, but then it gave back everything once Nasdaq futures were down 2% again. And it is not just that equities is falling only. All asset classes are getting hurt or getting hit. Cryptos are getting hit. Precious metals are getting hit. And it is essentially US yield versus the rest of the global assets, which is the equation right now. So as long as US yields continues to go up, I think there will be outflow from all other asset classes till that happens. And US yield, 10-year yield, is now at nearly 3.2% from virtually zero few months back. And this will have huge implications for a lot of housing mortgage in the US. It has pressure on Indian RBI to raise rates. Essentially, the entire world is raising rates pretty much behind the US, and this definitely has ramifications as we go forward. So as I said, a sea of red. IT stocks fortunately did not fall today, but pharma, auto, banks, real estate, consumption stocks, FMCG, you name it, metals, energy, those sectors that had done well in the last couple of months, like energy for instance, was up 12.5% over last 3 months, but mercilessly beaten today, minus 2.7%. Excuse me. PSU banks also minus 15% now on the quarter. Real estate minus 13%. So nowhere really to hide, and dramatic falls. In terms of broader indices, while Nifty closed only 0.67% lower, the internals, Nifty Next 50, small cap, mid and small cap, were all nearly 2% down. And today, with the broader base of stocks falling much harder, weekend investing performances were much, I would say, weaker than even the indices. So they were MI20, MI35 almost down 4%, MI all cap down 3.5%, NNF10 down 3%. Really ugly day from a perspective of one day fall. MI ATH2 surprisingly was unhurt today. And ATH also a minus 0.43%. These have been raising cash. I think MI ATH is now at 50% cash. ATH2 I think is at 30% cash. And some cash has been raised in MI25, MI50 also. So I think another few days like this and we'll probably go to larger cash positions on several of them. So very tough days, no doubt about it. But within this mayhem, you also had stocks which were running up. So BASF was up 8%, No Sale up 6%, Tata Teleservices up 5%, Jamna Auto, Chola Finance up 5% each. On the downside, Privy Special collapsed 16%. We have this in a couple of portfolios. Hind Copper down 10%. Gujarat Ambuja Export also we have minus 8%. MTR Tech, CSB Bank 8% each. So some ugly cuts on several of the stocks. So needless to say, these are tough times, and we may be just in the beginning of the tough times. So we may not be towards the end of the tough times, but may only be in the beginning of the tough time. And so what are the perspectives or insights that we can sort of gather from what we've seen so far? So one of them was, you need to think about, what was driving the markets in the last couple of years. And now markets are going down. So what is driving it down? So was it really earnings that were taking the market up last 2 years? And is it earnings that is bringing the market down? Or is it more to do with liquidity and fund flow? While there is a correlation there that earnings will bring forth more liquidity to that particular sector or stock, but usually what we've seen is that liquidity precedes earnings, and essentially the debate between whether you want to do fundamental investing or price-based investing, you need to decide, or if you can combine them in some ways, that will be nice as well. My preference, of course, is to go with price-based investing, in the sense that it gives me a very clear indicator of where things are going. Another one was, so a lot of new users have come into the market in the last couple of years. Demat accounts have gone up from 2.5 crores to something like 7.5 or 8 crores. And even within these 2 years, many have come in the last 6 to 8 months, where the market has been either stagnating or falling gradually. So now for them, the experience so far has been pretty bad. And the ones who came in maybe a year and a half back or 2 years back, they're still sitting on good profits. So if you extrapolate the last 5, 7, 8, 10 months of market moves and say that, this is going to happen every 10 months, then that is a wrong way of looking at it, because markets always moves in cycles, and usually the cycle lasts between 2 and 5 years, where you have a euphoric run and then the market collapses, and you have business cycles as well as various liquidity cycles depending upon global flows. So there are all kinds of cyclical waves moving around, and usually it is seen 3 to 5 years is a reasonable time where you will be able to catch one or maybe more than one large upswing. So if you look at back at history, we had a major down year in 2008 after 4 years of 2003 to 2007 bull run. Then 2008 was down, 2009 was a huge run again, and 10, 11, 12, 13 were sort of nothing years. 14 we had a major run when Modi win happened. 15 again we collapsed, I think somewhere around 15% on Nifty. And 16 and 17 were again good years, post which 18 was a really bad year. And then 20 March we collapsed, and then we had a very nice second half, 20 and 21. So you are seeing that every 3 years, 2 years, 3 years, at least definitely in 5 years, you will get one very good opportunity. And my belief, and we have shown in several daily bytes, is that even if you started at the peak of any of these moves, and had you brought your capital gradually in over the next few years, you would still ride it out very well and be at a reasonable gain within 3 to 5 years. That has been the experience so far. More insights of handling tough times. One was that no market strategy can really avoid a drawdown. So unless some wizardry is happening, and there are wizards out there, I'm not saying it is not possible. There are very astute traders mostly, But in investing, where you are mostly doing long only, and in case you're not hedged, you will have years of downtrend, and it's very difficult to avoid that. So stick with the strategy, stick with your confidence, that you have on your strategy, or with your advisor, or with your research company, or not be in the market at all. I mean, this is not a place for just throwing money at the market and seeing if it will stick or not. So it'll thrash you badly if you try to do that. So no adventure sports should be tried here. This I've already mentioned, because the US yield is going up, and money is flowing into the dollar. So it does seem like, what are we doing wrong here in India? Why are we getting penalized? But it's all very interconnected. We were going up because global liquidity was sloshing around, and now it is receding. The tide is receding, so all asset classes are going down. So there's a huge externality impact on the price, whether we like it or not, whether we recognize it or not. Earnings, yes, they have some role to play, but there's a huge external impact on the way stock price is going to move. So we need to understand that, analyze that, and see how we can use that. Another insight was on momentum strategies in general. So in momentum strategies, what is happening? You will have 50-60% of the invested trades not give you any return. Maybe they'll result in losses, small losses, 5%, 10%, 15%, 20%. 20-25% of the transactions may result in similar to market returns. The market is up 30%, maybe you'll get an average 30% returns on those transactions. And then there will be like 15-30% transactions where you'll get maybe a multi-bagger, several folds up, 50%, 70%, that kind of a move. So these are the transactions that will make up for those smaller losses that you had in the 50-60% range. So that's how this all works out. Probability of winning in any particular one stock remains very poor, but the ones that will run will make up for that low probability of win. So as long as your overall portfolio is doing well, it's beating the index, should not be any reason to worry. Another insight posted was on gold. So Worth Charting had this table where they have plotted all the major crisis years in the US markets and S&P 500 returns in those periods. So 1929 to 1932, the Great Depression, S&P return minus 86%, gold return in the same period 0%, gold relative to S&P plus 86%. Or we can see more of, maybe this was the Black Monday crash 1980 to 82, minus 27%. Gold also fell down, minus 45%, minus 18%, relatively flat. 73 to 74, when the Nixon window was removed on gold, S&P returned minus 48%, gold was up 137%. You had a relatively outperformance here. More recently, COVID crash, minus 35% S&P, gold dropped minus 3%, good hedge. So what we've seen is that mean and median, if you see whenever S&P 500 is collapsing, you are having some positive outcome on gold on average. And that's the whole role of a hedge in a portfolio. So do create this hedge, do asset allocation in your portfolio, and should help you in your overall returns, reducing the volatility of your returns. Another insight today was about HDFC Bank. So HDFC Bank had reached a pre-pandemic high level again. It had done so in month of March also. And the same level has come after 2 years. So before the pandemic, if this was supposedly fair valuation at that point, then 2 years later is definitely much more fair valuation, right? So from that perspective, it may be an opportunity for fundamental investors or those who wish to do very long-term investing without looking at the price. They may be looking at this opportunity, and this is just a highlight of that. Another insight today, the last one, was on the US dollar INR. So we've been calling this last many weeks, and today it has broken out. 77.42 on the dollar, and we've broken to an all-time highs on the USD INR, or you can say we've gone to all-time lows on the rupee, and this will further cause issues on the crude oil front. Crude oil becomes more expensive. All imports, whether it is gold or we are importing all kinds of oil now. Now, while it will help IT firms, like the IT firms did not collapse today, they actually gained ground somewhat, but a collapsing currency does not really help the market, and we may have to suffer some ratings issues also going forward. So that is another sort of a sort of a hidden roadblock that may come around if some Fitch or S&P comes around and downgrades our the government bond. So this is another sort of alarm bell, I would say. I mean, so far I think RBI was holding it very well. Maybe it was defending some situation at 75, 76, but now they've let it go. And the Chinese currency is also moving very fast. The Japanese yen is slipping very fast against the dollar. So you can't hold your currency for too long because you become comparatively weaker versus others. So this is another insight for the market, and I am very, I would say, hopeful that we will get to some intermediate bottom of this current downfall soon. However, I'm not so hopeful that we will see a bottom of this fall anytime soon. So we may bounce from tomorrow or maybe day after, I don't know, because we are reasonably oversold. But I think the market will seek much lower bottoms in times to come, because Nasdaq, S&P 500 are still looking pretty weak in terms of their charts. And on the last sort of note on this, from a valuation perspective, although I don't really look at valuations, but I was just having a chat with somebody, and from valuation perspective, Nifty forward earnings is not looking so bad in terms of maybe around 18 times next year's earning, and long-term average maybe between around 17 maybe. So from that perspective, we don't have much to go on the downside to reach fair valuation, but of course we can always undercut that and go down for a short period. But that should give hope to a lot of people that we are not too far away from where some balance can be achieved. So with that optimistic note, I come to an end to this daily bite. Thank you so much for watching. Please do share this with your friends and family. Please do let us know if you would want any change in what we're doing here, and I'll see you in another video. Bye.